As the Trump administration seeks to renegotiate trade deals with the rest of the world, the stock market has seen increased volatility, sending panic among some investors. What to do? Keep calm and keep your long-term goals in mind, says our next guest, Lawrence Sprung, founder of Midland Financial and the author of Financial Planning Made Personal. He joins us now live. Good to see you, Lawrence. Now, last time you were with us, you told us that these last few weeks has been one of the highlights of your career. So before we jump into the advice, could you just give us a quick summary of what's actually taken place over the last month?
Yeah, it's been one for the record books thus far. It's been pretty interesting. I've been through a number of these downturns in my 25 plus year career. But the one interesting about this is it didn't start with any kind of economic issue. It really started with the implementation of policy, these tariffs. And as I've said ad nauseum over the last 25 years, markets can always deal with good news, obviously. They could also digest bad news. But the thing that they have a lot of trouble with is uncertainty. And that's the period we've been living in over the last several weeks.
Now, over the course of 365 days, you've explained to us previously that 10 days can really make or break your investment portfolio. So can you explain that phenomena?
Yeah, so if you look back to the year 2000, so the last roughly 25 years, the market, the S&P has averaged about 9.8%. But if you were unfortunate and decided to try to time the market and get out at the top or get in at the bottom, and you missed the 10 best days of the year, your return plummets really from 9.8% on average to minus 12.5%. So what that tells you is timing the market is really an act of futility. You have to make sure that your portfolio is positioned properly because you want to make sure that you are invested during those potentially 10 best days. And I think the ironic thing is if you look back historically speaking, the vast majority of those 10 best days come after some of the worst.
So interesting. Now, long-term investing, as you're alluding to, is about patience and compounding your interest. So what do you advise your clients who fear a down year in the markets could quash their financial goals?
Yeah, I think that down years are something that you have to expect as an investor, right? We can't go into making investments, whether it be for our retirement or child's education, and expect that every year is going to be a positive year. And, the proof is in the pudding. The longer you stay invested, the higher likelihood that you are going to have a positive return. If you just invest for 1 year, the likelihood drops significantly, but the longer time horizon you have, the more likely you are going to get a positive return. And that's why, it's the old adage, time in the market, it's not about timing the market.
Yeah, let's explore that a little further, because whether it be stocks or real estate, people are always talking about trying to time the market to buy low and sell high. You're clearly advocating against that, and you're saying it's actually time in the market rather than timing the market. So can you go a little deeper on that?
Yeah, so I mean, if you go on social media, there, you'll get an indication that basically there are some people out there that can completely time the bottom and time the top and, get out and get in when needed. But I would argue that they're probably not going to be around very long. They can get rid of their handle very easily and you're no longer following them. So, it's proven fact that the longer you invest in the market, that the likelihood of your returns go up significantly. So, for example, if you are invested for 5 years, you have roughly an 80% chance that you're going to have a positive return over that 5-year period. At 10 years, it goes up to 90%, and at 20 years, you're almost at you're right at 100%. So, if you can invest for the long term, there's empirical evidence that shows that you'll see positive returns. But you have to also understand that the volatility is the price that we pay for those returns. So you have to be prepared that not every year is going to be a positive year, and that there are going to be some down years in your horizon. And I'm not saying that, going back to your 10-day example, I'm not saying that this year, although we've started on the downtrend, that we end there, because those 10 days could be ahead of us.
Yeah, and I think an important distinction is you seem to be laying out the differences between a true professional trader and someone who's an investor, and they're looking at, as you said, social media, and they read about somebody who is claiming to have timed the market. Can you make a little bit of a distinction between those two and to encourage those who are truly investors to not gamble?
Yeah, I think most of the your viewers here today are probably investors. They're not going to be professional traders. So, professional traders are people that this is what they do for their job day in and day out, and they're being paid to time the market. And in a lot of cases, they can't even do it. In recent years, you've seen a lot of what we call traders come out of the woodwork, which are basically algorithmic trading platforms that are now trying to time the markets tops and bottoms. Most of your viewers are investors, so they're investing for some goal in the future, whether it be retirement or making work optional or sending their child to school, college debt free, or maybe buying that vacation home. So they should be aligning their investments with those various time horizons. So if their child, for example, is going to school in 10 years versus 18 years, those portfolios may look very different. And they have to align their portfolios in such a way that they can withstand some of the volatility that we've seen recently.
Yeah, you couldn't pretend to be a doctor, and if you're not a big data guy, maybe you shouldn't pretend to be a professional trader and stick with investing. Now, as we finish up, can you assuage people who have fears of a market correction?
Oh, I think we're in the midst of a market correction to some degree as we speak, and market corrections are totally normal. I mean, we typically average at least one market correction per year, and the average downside that we usually see around a 14% decline in the market. So, although we still have a long way to go this year, we're in the midst of that correction at the moment. I think, we're hinging on whether it gets a little bit worse or we get better. And a lot of that's going to depend on some of the policy that we see. Because if you are looking at the markets and seeing what's going on, a lot's hinging on that policy, depending on what's being said from one day to the next. So we might be in the midst of that. And what I would say is for those people, going back to what we spoke earlier, that have that longer term time horizon, this could present a fantastic opportunity for them. Whereas, 6 months ago, the markets were significantly higher. And I think those people that are getting closer to one of those events, whether it's, buying that home or college or retirement, really need to be sitting down with their advisor and seeing if they're still on track or off track, and maybe making some minor adjustments, because sometimes those minor adjustments can lead to major improvements.
Stay calm, carry on. Always fun to speak with you, and certainly reassuring as well. Lawrence Sprug, thanks for joining us this morning.
Thank you, Kerry.